Welcome to Corporate Finance. Session number 7, we're going to look at interest rates and bond valuation. How do interest rates affect the value of your bonds once you buy a bond someday? Do you have to keep an eye on interest rates? We'll look at the one formula. In my hands, I have here a U.S. Treasury bond. What's it worth, and what kind of a bond is it? Doesn't look like it has any coupons attached to it, so it's a zero coupon bond. It's a discount bond. I bought this one for $25, and at the end of its term, it's valued at $50. I expect to get $50 back. What I've found with these bonds is I even get more back sometimes. Sometimes they keep generating interest while they're lying in my safe deposit box, and I didn't know it till I actually cash some of these in. You can actually look at the value of your bonds by going to USTreasury.gov, and type in the information off the bond, and it will tell you what this is worth. So we're going to look at some of that. We're going to look at several key learning objectives. Number one, how do we value a bond? What's the one formula to value a bond? It's the present value of the coupons and the present value of the face value out 30 years from now if it's a corporate bond. We're going to look at some bond features. How many bonds were issued in this offering? Is it callable? Is it puttable? What is the coupon rate? And what are all other bonds in the market paying at that time that you bought it? Who rates bonds? Who are some of the key rating agencies to help protect you, the bond investor? Companies like Standard & Poor's, Moody's, and a new one, Fitch's, rate bonds for you, and you can see the safety of your bond by looking at those bond ratings. What are some types of bonds? Not just corporate bonds and government bonds, but all kinds of other different bonds, income bonds and catastrophe bonds, just even something crazy called a burrito bond. We'll discuss all of those things. Where do we buy these bonds? Where are the bond markets? Is there a store downtown where you can go in and buy a bond? Who do we visit to buy a bond? How does inflation affect interest rates? And how do interest rates affect bonds? We'll look at that very closely, and we'll look at the math behind it to see why bond values go down when interest rates go up. And finally, we'll look at some determinants of bond yield. What are the 3 key determinants of a bond yield? We'll look at that at the very end of session 7. And we'll call on Bruno Mars to give us a little bit of 24-karat mnemonic moments of magic and the bond formulas. Everything regarding bonds revolves around this equation. The key thing to know is what is the relationship between the coupon rate and the yield to maturity. Coupon rate being the rate on my bond, and the yield to maturity, the rate on all other bonds in the market. You'll see some familiar formulas here. The first part of the bond formula is the present value of the coupon, C times 1 minus 1 over 1 plus R, the T, all of that over R. And we have that in Chapter 6 as the mortgage equation, car loan equation. Also, the face value of the bond, the $1,000 that I paid for that corporate bond, discounted back to today, is also part of the bond equation. That part of the equation, FV over 1 plus R, the T, comes from Chapter 5 in the form of future value, present value formula. Another very important equation in this chapter will be the Fisher effect. How do we calculate the total nominal rate? Nominal means total of return. It's composed of a real rate of return and an inflationary component. H, so little r is the real rate, and H is the inflation, and big R is the nominal or total rate. Nominal means total. So remember that Fisher effect, very, very important. So if you're, for instance, as an example, if in your first job you receive a total raise of 3%, big R, total nominal, and inflation, H, has been running at 3%, as it has on average for about the past 90 years, you actually received a raise of 0 real. So we'll use that Fisher effect very soon in your working life. Bond valuation formula, as I said, there's only really one bond formula, and it is a combination of Chapter 5 and Chapter 6. First of all, present value of the bond is the price of the bond when. What does present value mean again? It means today. So this is the present value of the coupon, C times 1 minus 1 over 1 plus R to the T. And then all of that in the numerator divided by R in the denominator. And we're going to call that the present value of the coupon. And then the present value of the face value is equal to the Chapter 5 formula FV over 1 plus R to the T. And this we'll call the present value of face value. Two components of the price of the bond or the bond value are the present value of the annuity of the coupon and the present value of the face. Bonds are just simply debt securities. They allow corporations to borrow money from you and I, the public, over the long term. Typically, corporate bonds run 30 years, but they can have any maturity date, and government bonds, same way. Bonds are basically just interest-only loans. You loan the money to the government in the form of that bond I just showed you, and they pay you back at the end of N years, depending on the terms in the indenture. Interest is paid every period, and principal is paid back upon maturity. So in the case of a corporation, the corporate bonds are generally $1,000. You put up $1,000 today, go to your bond dealer, and have the bond dealer buy you a corporate bond, $1,000, and then you get that $1,000 back in 30 years. And to keep you interested, the company will pay you a coupon each and every year, sometimes twice a year, semi-annual, but to keep you interested. And there's a whole new language of bonds that we need to learn. The coupon is that thing that gets clipped off, hanging at the bottom of the bond. It's a stated interest payment and paid at regular intervals, as I said, once a year or twice per year for corporate bonds. Face value is the principal amount of the bond, usually $1,000 for corporate bonds. So if I want to buy an Apple bond, I put up $1,000. If I want to buy a Facebook bond, I put up $1,000, get that $1,000 back in 30 years. This is a very important ratio. The coupon rate is the annual coupon, the annual amount that you get from the paying agent, divided by the bond face value, like I said, usually $1,000. Or corporate bonds, maturity date is the date when the principal amount is paid, and for corporate bonds, it's usually 30 years. Not to say that they can't come in different maturities, but very often it's 30 years. A zero coupon bond has no coupon. So you see this bond, picture of this bond with no coupons at the bottom to tear off. This is a U.S. Treasury bond, a real old one, and there are no coupons. So it's a zero coupon bond, and that formula, the middle part of that formula where you have C, the annual coupon amount in dollars is zero. So the whole middle of that formula falls off. Yield to maturity, or YTM, is rate required by all other bonds in the market. Very simply, what are all other bonds paying? And that is called the YTM. That is equal to little r in the formula. That is a rate required by all other bonds in the market. And we compare that to the coupon rate on your bond, which is your bond's coupon value in dollars divided by bond face value. There's an inverse relationship between interest rates and bonds. As interest rates go up, bond values go down. And that's because of the formula. If interest rates go up, R goes up, rate required by all of the bonds in the market tends to rise, and then you're dividing by a larger number, so bond prices, when interest rates go up, bond prices go down. Some key terms of a bond. When a bond is first purchased, it's called a face value or par value bond, and that is $1,000. In this case, the coupon rate on that bond is equal to the market interest rate, what all of the bonds in the market are paying. In a discount bond scenario, your bond is selling for less than $1,000. Your coupon rate is less than the market interest rate, and no one's willing to pay you $1,000 for your bond. They'll go buy a face value bond for $1,000 and get a higher rate of interest. A premium bond is greater than $1,000. That's selling for greater than $1,000, greater than par value or face value. The coupon rate is higher than the market interest rate, so the coupon rate on your bond is higher than what's being paid out there in the market. and you should get more than $1,000 where you go to sell that bond sometime in a 30-year period. Think of premium gasoline when you think of premium bonds. They sell for more than $1,000, and there's a reason. It's because the coupon rate on your bond is higher than the market interest rate or YTM. For bond owners, certain levels of risk can arise, and to minimize interest rate, one being interest rate risk, to minimize interest rate risk, keep your time to maturity short and keep your coupon rate high. And again, that ties back to the formula, to the one formula. If C is higher, that will tend to give you a higher bond price and minimize your interest rate risk. You can see on this chart very clearly that if you keep your time to maturity short, 1 year, that the bond values don't fluctuate as much as if you had a 30-year bond. And again, you'd be typing in T equal 30 in this case, and the bond value fluctuates. If you bought this bond with a coupon of 10%, you can see what happens if interest rates go down. The bond value goes way, way up on a 30-year bond, not so much on a 1-year bond. And if interest rates go up, bond values go down, and they go down substantially with a 30-year bond. So again, if you want to minimize your interest rate risk, keep your time to maturity short and your coupon high. Bonds issued in the U.S. Usually make semi-annual coupon payments 2 times a year. So to adjust that bond formula, you must divide the coupon by 2, C dollars divided by 2. Also divide R by 2 because the required rate of return, or YTM, is closely allied to the coupon rate. And you must multiply T times 2 because you have to go in to see the paying agent twice a year, or half the amount of the coupon. Here's a sample practice problem for semi-annual coupons. Again, with semi-annual, when you see that word and you're using the formula, you must take C divided by 2, R divided by 2, and T times 2. $1,000 face value bond is quoted as having a YTM of 14%, a coupon rate of 14%, YTM of 16%, and let's do the problems. So the coupon is in dollars. 14% divided by 2 is 7%. And then times 1,000 gives me a coupon of $70. Little r is R by 2, so 16% yield to maturity divided by 2 is 0.08. And T times 2, 7 years, times 2 is 14. I'm going to plug in 14 for T. And then, as always, 1,000 or FV, and I get a bond value on the semi-annual coupon bond of $917.56. This is a discount bond because it's selling for less than $1,000, and the reason it's a discount bond is because your bond is this is your bond. It's only paying 7% semi-annually, or $70 of a coupon, whereas all other bonds in the market are paying $80 or 8% coupon. So you have what's known as, again, a discount bond selling for less than $1,000. If yield to maturity is unknown, but a bond's price, through trial and error, you must guess and check at the R's, and you can guess smartly. If the price of the bond is less than $1,000, your coupon rate on that bond will be less than required rate of return on all of the bonds in the market. And if you have a premium bond selling for more than $1,000, your coupon rate on your bond is greater than the YTM, or rate required by all the bonds in the market. So you can guess, if you're solving for R, there are 3 R's in that formula, and you can guess at it by guessing smartly, according to this slide. Corporate securities, when I use the word securities, as we discussed in Chapter 1, securities are just bonds and stocks. Debt securities are known as bonds, and equity securities are stocks. The creditor or lender is a person or firm making the loan, so that might be you loaning your money to a corporation or the government, and a debtor or borrower is the person or firm borrowing the money. Debt versus equity. Debt is not ownership. All you have is an interest-only loan. Corporations' payment of interest is a cost of doing business and is fully tax-deductible, so it reduces your taxable income, unlike dividends. Unpaid debt is a liability that must be paid before any equity holders are paid, so debt takes preference in bankruptcy or financial failure. This doesn't happen with equity. So debt can lead to financial failure and bankruptcy. Be careful on the amount of debt that you take on in your company and also in your personal life. As we said in Chapter 3, the ratio chapter, that Harold Janine, who was president of ITT Sheraton, found that a good, quote-unquote, long-term debt-to-equity ratio that worked for him and his conglomerate was 33.33%. Keep your long-term debt to about a third of your equity, and you'll be able to raise more debt or float stock very easily once you are in contact with Wall Street. No voting power with debt. That comes with stock. Long-term debt typically viewed as with maturity dates of more than 1 year. Short-term debt maturity less than 1 year, unfunded debt. Debt securities are also called sometimes bonds or debentures or notes. Sometimes you may just even borrow some money from a relative, and that relative may have you sign a note. An unsecured short-term debt. Payment on bonds. The bearer of a bond is entitled to receipt of the principal at maturity, which is typically 30 years for a corporate bond. And you're entitled to payment of interest on bonds or the coupon. Coupon is recorded on that income statement as interest expense. Hopefully that makes sense to you. And again, that's tax deductible, reduce your taxable income. And total debt, the amount of the debt issue, the full amount borrowed, appears on your balance sheet at the company under long-term debt.